By investing only in index funds, is it possible to retire as a millionaire? Yes, without a doubt. Gaining financial success through index fund investing depends equally on the why and how. Let's look at how this can happen for you regardless of your starting financial situation. Welcome back to another interesting episode. In today's video, we will be showing you how to be a millionaire with index funds. Do make sure to like, share, and comment below, as it also encourages us to produce more valuable content for you all. If you have a specific topic you'd like to learn, please leave us a comment below and we'll work on it for you. Before we dive into it, let us take a look at what index and mutual funds are. Index funds are financial instruments that aim to replicate the performance of a specific index, such as the S&P 500 index. You will earn the same amount of money, 8%, if you own an S&P 500 index fund, and the index returns 8% in a given year less any fund expenses, which are currently 0% or very close to it. A number of years have seen negative returns for market indices, so keep in mind that they do not return the same amount every year. Index funds are extremely effective for regular investors because they can earn this 8% without requiring active management on your part. As a result, you won't have to invest time and energy selecting and trading stocks, trying to predict which ones will rise and which ones will fall. In other words, if you invest your money and essentially leave it alone, you will get the market return. Mutual funds are an excellent way to invest your money. They can assist you in meeting your financial objectives because they have the potential to generate higher than inflation returns. The sooner you start, the sooner your money will start to aggressively compound. So if you only get one of these right, make sure it's this one. The longer it grows, the more you will profit from compound interest's subtle beauty, because money grows more quickly when it has a larger base. It's critical to continue investing despite where the market is currently trading, even at all-time highs. Set up a schedule for investing at any frequency, every week, every 2 weeks, etc. As a result, compounding will speed up while also ensuring that you keep expanding your portfolio. Consider the scenario where you accept that an S&P 500 index fund is beneficial to you. Choosing an S&P 500 index fund from one of the discount brokerages, Fidelity, Schwab, or Vanguard, and intending to hold it for a long time are your only options. Additionally, you'll pay a lower tax rate on any accumulated gains after a year has passed. In the event that the market declines, as it most recently did in March 2020, there will be a temptation to sell. The ability to preserve through the most challenging marketing conditions is a key component of successful investing. Despite the fact that it is much simpler to say than do, index investing must have this aspect. Fidelity U.S. Sustainability Index Fund. Investors interested in sustainability should consider the Fidelity U.S. Sustainability Index Fund. The fund's benchmark is the MSCI USA ESG Leaders Index, which tracks the performance of large and mid-cap domestic stocks with above-average ESG ratings. There's no minimum investment required and an expense ratio of 0.11% for the index fund. The fund's largest concentrations as of March 31st, 2022 are in technology, 28.6%, healthcare 13.5%, and consumer directionary 12.8%. This sustainability ETF's top holdings include Microsoft, Tesla, Google parent Alphabet, Nvidia, and Johnson & Johnson. Although ESG funds are appealing to those looking to invest with a strong ESG focus is also advantageous to returns. ESG funds, such as the Fidelity U.S. Sustainability Index Fund, are a wise choice for long-term investors because businesses with low ESG-related risk frequently outperform their competitors financially. Schwab Emerging Markets Equity ETF. If you want portfolio exposure to high-growth emerging markets but don't want your risk concentrated in a single economy or region, the Schwab Emerging Markets Equity ETF may be a good fit. The FTSE Emerging Index, which compiles large and mid-cap stocks from more than 20 developing nations, serves as its foundation. Most of the 1,843 holdings in the fund are in China, Taiwan, India, Brazil, and South Africa. It has an expense ratio of 0.11%, and in the past, stocks in emerging markets have performed worse than those in the U.S. Between 2012 and 2021, the Schwab Emerging Market Funds returned approximately 67%. The S&P 500 has gained more than 350% since its beginning. Around 85% of the world's population lives in developing countries, so its long-term investors who are accustomed to volatility ought to give this fund some serious thought. Vanguard Russell 2000 ETF. For investors looking to take advantage of the potential upside of investing in small-cap companies, the Vanguard Russell 2000 ETF, which tracks the Russell 2000, is a good place to start. The fund invests in 2,032 small and mid-cap companies with a $2.9 billion median market capitalization. As of March 31st, 2022, the index fund's largest concentrations were in healthcare, 16.1%, financials, 15.9%, and industrials, 15.4%. The expense ratio of the fund is at 0.1%, is relatively low, especially for one that provides exposure to companies with the greatest growth potential. The Vanguard Russell 2000 ETF, like its benchmark index, underperformed the S&P 500 during the first 5 months of 2022, falling about 20%. Vanguard Real Estate ETF. The Vanguard Real Estate ETF is a good low-cost option for investing in the real estate market. It is also by far the largest real estate index fund, with approximately $86.3 billion in assets under management and an expense ratio of 0.12%. The MSCI U.S. Investable Market Real Estate 2550 Index serves as its benchmark, broadly tracking the U.S. real estate market. Even though the index includes a few real estate management and development firms, it is primarily comprised of equity REITs, which own and operate income-producing real estate. The ETF is appealing to dividend investors because it invests primarily in REITs. The fund's 12-month dividend yield was 2.45% as of May 2022. Because real estate has traditionally been viewed as an inflation hedge, the Vanguard ETF may also appeal to investors concerned about inflation. Vanguard Growth ETF. Vanguard Growth ETF is a good choice if you want to take on more investment risk in exchange for higher returns. The fund tracks the CRSP US Large Cap Growth Index, which is similar to the S&P 500 Growth Index in terms of performance. This ETF invests in 266 large cap growth stocks in the United States. Tech stocks holding for 49.7% of the fund's holdings, followed by consumer discretionary stocks at 24% and industrial stocks at 14%. Only 0.9% of the fund's value is made up of energy and utility stocks. This ETF has an extremely low expense ratio of 0.04%. The fund's average annual return over 5 years before taxes was 24.78% as of December 31st, 2021, easily outperforming the S&P 500. However, as technology stocks continue to plummet in 2022, the fund was down by around 28% through May, far more than the S&P 500. Investing in Vanguard's Growth ETF, however, may provide an opportunity to buy the dip. Schwab S&P 500 Index Fund. The Schwab S&P 500 Index Fund is about the cheapest official S&P 500 index fund you'll find. It has a 0.02% expense ratio, which means that for every $1,000 invested, you'll only pay 20 cents per year. Because of the low investment fee, the returns are nearly identical to the S&P 500's performance. The fund's total returns of 31.43% in 2021 were nearly identical to the S&P 500's. Both the fund and the S&P 500 had lost about 16% year to date by May 2022. You can begin investing with as little as $1 because there is no minimum investment amount. Fidelity Zero Large Cap Index Fund. The Fidelity Zero Large Cap Index Fund, which tracks an index of slightly more than 500 large cap stocks in the United States, outperforms the S&P 500 Index Fund. However, because this fund is not an official S&P 500 index fund, it avoids paying expensive licensing fees to the index parent company S&P Global, New York Stock Exchange, SPGI. As a benchmark, the fund follows the Fidelity US Large Cap Index. The word zero in the fund's name indicates that it has 0% expense ratio. There is also no minimum investment amount, making the fund an excellent choice for new investors. The fund closely tracks the S&P 500. Total returns since its beginning in September 2018 were 43.4% as of mid-May 2022, just short of the S&P 500's 44.2% return during the same period. The fund was down about 18% in early 2022, slightly more than the S&P 500. There are countless ways to reach $1 million through index fund investing, but the best way to do it is to invest as much as you can, as soon as you can, and to have the nerve to leave it alone in the market changes. Make sure your big ideas are sound, and then let the market take care of the rest. The content in this video is for educational purposes only and hence should not be considered financial advice. All the financial decisions should be made after doing your wide spectrum research. If you found this info helpful, please give a thumbs up and subscribe for more content like this, as it also encourages us to produce more valuable content for you all. If you have a specific topic you'd like to learn, please leave us a comment below and we'll work on it for you. Until then.